So hey guys, what's up? Welcome to this video today. My name's Richard Norris. I've been investing in property for the last 12 years. I've actually been in property for over 19 years. So I've been pretty successful in the space. I've grown a multi-million-pound property portfolio in the UK. Now started to diversify my investment portfolio internationally and here where I live in the UAE. So in today's video, I want to talk about the differences around buying property in the UK versus buying property over here in Dubai and in the UAE as a whole. So stick around in this video. We're going to do a deep dive into the main differences. You're going to learn a lot. So first point, when it comes to buying property in the UK, the very first thing that I've done and that works really well for my clients is using a model called the buy, refurbish, refinance, repeat model, where we basically buy properties below the market value. So we buy them at a discounted price. We then add value through refurbishment, and then we can command a higher value and refinance the property, pulling most, if not all of our capital back out of that deal to recycle the same pot of money using the same pot of cash to buy property 2, 3, so on and so forth. That's the traditional model that professional property investors in the UK like myself use, and it's kind of like the cookie cutter bread and butter model to build wealth in the UK property market. However, in Dubai, it's a completely different thing. The Dubai market's a little bit different, where particularly in my situation, what I do is I buy off-plan property in Dubai. So it's a very different strategy. Now, over in the Dubai market, typically what I've found since living here since November 2022 is that most people who are big into property in Dubai don't really hold the assets, and it's more of a developer's market. So they'll buy off-plan investments, like I've just bought an off-plan investment in Emaar Beachfront. It's in an address, signature branded residences. It's called Bayview. We buy off-plan and we have to fund that 100% cash. And it's kind of like we buy it hoping for capital appreciation to sell then to the secondary market. I'm going to talk about the discrepancies as we go throughout the video because there's different financing structures, and the problem is the entry point to the UK market is a lot lower than, say, for example, the UAE. So the problem in the UAE is the entry point is higher. So we're buying properties for, like, if we're buying in prime location, typically around £800,000 to £1 million for a one-bedroom apartment in Dubai. So we'll buy, we'll let the property appreciate. Once we've made 50% of the payment plan, we'll then sell for profit. So it's more of a developer's model. And the other model that we use here in Dubai is we can basically go and buy properties that are already been built, that might be run down. Again, similar type of model to the UK. This is actually where it is similar. We can renovate and then we can actually sell for profit, but we're doing the developer's model as opposed to buying, refinancing and repeating. We're not holding the stock in Dubai. And one of the main reasons for that is because Dubai is kind of like a less mature market. So from my understanding of being in Dubai, and again, I am still quite new to Dubai, it's only 2 years versus like 19 years in the UK. So of course, my knowledge around the UAE market compared to the UK market is a lot lower. Therefore, I have like less financial perspicacity of how the UAE works compared to the UK. But on a comparison like for like basis, the UK tends to be a stronger market, whereas a mature market, we've seen in the UK years over years, over decades, over centuries even, that house prices tend to double every 10 years. So we can rely with a certain level of certainty that we're going to get good capital appreciation over the years, no matter really where you buy in the UK. If you go over to Rightmove, you scroll the search, the property data, look at the search history, you're going to see that if you leave and hold that property, so buy it and hold the property for long enough, you will get capital appreciation, even though we encourage you to, and I encourage you specifically in the UK to buy for cash flow. In the UAE, because it's a less mature market, it's a more transient market, it can be more volatile, and therefore most people would encourage you to kind of flip like a developer, get in and out quickly, take your profit, as opposed to buying and holding for a long time and renting the units out. The next thing is talking about the financing structures. So the financing structures in the UK compared to financing structures in the UAE. Typically speaking, like the UK financing structures, you're going to be like using mortgages or bridging loans, cash in, mortgage out. So typically speaking in the UK, general rule of thumb can go up to 75% max loan to value on a buy-to-let property investment, and you're going to be investing on an interest-only mortgage. In the UAE, when you're buying off-plan investments specifically using that strategy, you're going to be using cash. You can only buy off-plan in the UAE using cash. So again, that's one of the downfalls to getting started in property in the UAE. You're going to need a lot of cash if you're going to be doing an off-plan property development model. And you can only get a mortgage on handover when it's completed. So it's very cash intensive, and you've got to wait a long time to be able to see your return unless you're selling to the secondary market once you've paid over 50% of the payment plan. The second thing is if you do buy property in Dubai, which is already built, so it'd be like an already built property, it's not off plan, and you may be adding value to it, you can get 80% loan to value on the property. Loan to value here varies, 60 to 80% loan to value on the property, but most of the time it's going to be on a full capital repayment mortgage, and it's not going to be interest only. And that's another discrepancy between the UAE versus the UK, where UK, you can either get interest only mortgages or you can get capital repayment mortgages. Most people, if you're growing a property portfolio, we're generating cash flow in the UK, we're going to be looking for cash flow over capital appreciation, we're going to be putting everything on an interest only mortgage. Whereas in Dubai, pretty much most of what you buy, 60, 70, 80% loan to value, and it's going to be capital repayment, which means that your cash flow from the asset, if you're investing in the asset, is going to be lower versus the cash flow that you get in the UK. The next point I want to talk about is purchase tax when you buy a property. So in the UK, you pay stamp duty land tax. Every time you buy a property in the UK, you pay stamp duty land tax. Now we know in the last recent budget, in the October budget, Rachel Reeves put up the stamp duty on second homes from 3% to 5%. So the current stamp duty land tax in the UK is currently measured like this. If you buy a property which is an additional property as a buy-to-let property investor, anything between 0 and 250,000 is taxable at 5%. Anything at 250 to 925,000 is taxable at 10%, and anything between 925,000 purchase price and 1.5 million pounds purchase price is taxable at 15%, and anything that's above 1.5 million pounds in value is taxable at 17%. Now, stamp duty, again, just for those of you who are new to property investing, stamp duty is just a tax. It's like a purchase tax. In Dubai, they have a similar tax, which is the equivalent to stamp duty land tax in the UK when you buy a property in Dubai, but it's called a DLD fee. And that is the Dubai Land Department. It's like a purchase tax, but that's a flat 4% on purchase price. So I just want to break down an example here so you can see how the discrepancies and differences are between the purchase taxes on stamp duty and DLD fees between the UAE and the UK actually numerically look like. So I'm going to use my property, the one that I bought last year, which is the property in Emaar Beachfront. I bought it for 3,760,000 dirhams, which is about 800,000 pounds. The exact number is actually 798,754 pounds based on today's conversion rate, which will obviously fluctuate depending on the day that you look at the conversions. So if I was to buy that property, that one bed property, and I was to buy it in the UK for 798,754 pounds, the tax that I'm going to pay is 67,375 pounds. Now, how is that broken down? On the first 250,000, so between 0 and 250, so the taxable sum is 250,000, is taxable at 5%, which is 12,500 pounds. Then the difference between 250,000 and 925,000, which is effectively the 798,754 minus the 250,000, gives you a taxable sum of 548,754 pounds, which is exposed to 10% tax, which is 54,875 pounds. So if we add those numbers together, the 54,875, the 12,500, the total stamp duty land tax that we have to pay on this one bedroom property if we're to buy it in the UK for a value of 798,754 pounds is 67,375 pounds. Where in Dubai, it's probably no surprise to you that the stamp duty, or what we call the DLD fee equivalent, Dubai Land Department fee, is less. It's just a flat 4% plus admin fees. So on this property specifically, if we look at UK numbers, 3,760,000 dirhams, equivalent 798,754 pounds, is only taxable at 4% DLD fee. So we'd only pay 31,950 pounds, which again, for transparency, we just take the 798,754 and we times that by 4% to give us a 31,950 pounds. So again, if we had to buy this one bed property in Dubai versus buy the one bed property in the UK, we're actually going to pay 35,425 pounds less taxes on the purchase price in Dubai than we would if we were to buy the same asset in the UK. So again, that's one of the biggest differences, is the purchase taxes, the stamp duty land tax in the UK versus the DLD fees in Dubai. Now, I am going to create a whole separate video as well, guys, around taxes in the UK versus taxes in Dubai, specifically when buying property and real estate investments. I'm going to create a whole video on that because we can go very deep on that. We can get right granular into the weeds, the nuts and bolts of how all of that works, but it would make this video extremely extensive and extremely long. So for the purpose of this video, to highlight the differences between the UK versus Dubai, I've chosen to leave that out. At the end of this video as well, you'll have like another video which you can watch on as like a follow-on series. In the coming weeks, you can basically watch that video which talks all about the differences between real estate taxes in Dubai versus real estate taxes in the UK. So without further ado, let's move on to the fourth difference, which effectively is market maturity. So again, I kind of touched upon this a little bit, but I just want to kind of go a bit deeper. So what do we mean by market maturity? Well, in my personal opinion, and it is only my personal opinion, having spoken to large developers in the UAE, some of the biggest developers here that I've become associated with, being a mature property investor in the UK, and again, speaking to some of the largest property investors in the UK, we'd kind of position it that the UK is a more stable, more mature market, which basically means that we've got more historical data. The infrastructure in the UK has been around for a lot longer. And so house prices tend to kind of like constantly appreciate. Typically speaking, they tend to appreciate and double every 10 years. That's kind of like high level, but we could say safely that if we buy an asset in the UK and we hold it for long enough, then we're always going to get capital appreciation. It's always going to be worth more in 20, 30, 40, 50 years time than what we paid for it today, mainly because of supply and demand. In the UK, we need to build 350,000 new homes for the next 20 to 25 years just to meet current demand. So because of the imbalance of supply and demand, house prices in the UK tend to be one way, which is ever increasing. Okay, so you're going to see appreciation if you hold the asset long enough. Whereas in Dubai, because it's a very transient market, you've got a lot of international money coming in through wealthy expats like myself, and even wealthier expats like Russian billionaires, for example, coming to Dubai. The market is very, very different. And what happens is money loves speed, and most of the time people with money tend to move to tax havens and offshore tax havens, which, as you all know, Dubai is one of those places. So when you're buying property in Dubai, because it has only maybe 50-ish years of infrastructure, it's a less mature market, it's a younger market. They have a lot of volatility because there's a lot of transient supply and demand metrics moving around. People use Dubai as a hub to either live for 1 or 2 years for a shorter period of time, or they use it as a place to go and be a tax haven, or they use it as a place to kind of transition through. So they come to Dubai for 3 months of the year, then they move on to somewhere else, like digital nomads. So because of the transient nature of the market in Dubai, there's only so much land available to be built on in Dubai. You don't have the same kind of supply and demand metrics, and you get more market volatility, more instability. So most people will tell you here that actually it's more, again, go to the developer's model, buy a property and then exit for profit, as opposed to hold for long-term capital appreciation. However, if you're buying prime property, so if you buy prime property in prime locations, what I mean by that is something in Dubai, it would be like considered like beachfront property. So if you buy a property on Palm Jumeirah on the Fond, of course, that would be a prime asset. If you buy it like the Royal Atlantis, it's going to be a prime asset. It's a prime location with amazing views. If you buy Emaar beachfront, private beach, maybe you get Dubai skyline view in the morning, sunrise in the Dubai Marina, and maybe you get the Palm sunset in the evening. That is a prime unit, it's a prime property. Those things tend to hold their value very well because wealthy individuals want to add to their investment portfolio prime property, and most of the time they're less concerned about the return or the yield they're getting, and they just kind of want to use it as almost like a collector's item. They want to say that I own this prime piece of real estate and it sits within my investment portfolio. The mentality is very different. We're dealing with 0.0001% of the population of wealthy individuals versus the market, which is like everyday people, like 95% of people, 95% of average wage. So it's a very different market. The next thing I want to speak about is main thing is like mortgages in Dubai. Again, I touched upon this a little bit earlier on in the video, but there's a big discrepancy between the Dubai mortgage market and the UK mortgage market. In the UK, obviously, the maximum loan to value you can get is 75%. You typically take it out on an interest only. You can kind of get like bridging finance. You can do mortgage in, mortgage out, cash in, mortgage out, bridging finance in, mortgage out. Dubai, there's less options available to you as a developer. The funding is similar, but the maximum loan to values that you would get would vary. Again, individual dependent, but typically speaking, like off plan, you can be on like a 60-40 payment plan. Like you might get 60% mortgage, 40% down payment. That could even be on a property that you buy. Like if it's an asset that's like worth 50 million dirhams or more, for example, which is like high-end real estate where you're buying on the fund, you're going to be at like a 60% mortgage, 40% down payment. So what does that really mean? If you're buying prime property in Dubai and you can only get like 60, 70%, say max loan to value, it means that you're tying up more capital. You're probably going to get a lower return on your investment, and you're probably buying for a lower yield compared to say buying somewhere like in the northwest of the UK or the northeast of the UK, sort of like anywhere from sort of the greater Manchester area through to kind of Newcastle and Sunderland, Yorkshire type areas where you can get 9-10% yield potentially, up to maybe 8 to 10% max on a residential property. In Dubai, you could maybe get that on a service accommodation model, but a general 12-month fixed AST contract, just as a buy-to-let investment, you're probably going to be averaging around 7-8% yield max. And on a prime property, you're probably going to be around the 5-6%, which is very much in line with kind of like your Londons and Oxfords of the UK. That's how I'd kind of describe it. And again, that's not conducive if you're starting out a property portfolio and you want to grow and leverage, because leverage and financial perspicacity is the key to building a property portfolio fast and developing a cash flow generating model. In my personal opinion, if you're starting out in property, I would say Dubai is a more mature market in terms of like higher entry price, and therefore I would start definitely in the UK, and I would turn my capital over using the buy, refurbish, refinance model, and I would consider Dubai as a secondary strategy like much further down the line. Like for me personally, I only just started investing in Dubai last year, and that was after 11 years of buying property in the UK, and I continue to invest heavily in the UK today, and the two strategies that I use in UK versus Dubai are very different. Like I said, in the UK, it's very much buy, refurbish, refinance, taking commercial office buildings, converting them into apartment blocks, maybe taking a 3-bed, converting it into a 6-bed HMO, for example, social housing contract. Even if I'm just doing a 2-bed buy-to-let property, I might split it into ground floor flat, first floor flat under permitted development rights, or I might just buy a 2-bed property and add value and refinance it. It's very much about refinancing properties, getting the highest ROI possible and having a cash flow generating strategy. Whereas, like I said, Dubai is much more, I can't leverage as much, so therefore I'm tying up a lot of my capital. I have to wait longer to see the appreciation. But the great thing about Dubai is you can make big profit. So you can buy something for, say, for example, in pounds terms, let's say £1 million, and maybe in 2 years' time you could sell for 1.3. That's not atypical to see in Dubai on the right investment. So it's a good kind of profit generating strategy, providing that you've got the funds to do that. And I appreciate that most people, that's a high entry point for them. So again, I just want to point out that Dubai is kind of a different market in its entirety. And if you're thinking about starting buying property, maybe use Dubai as an aspiration, as like a goal in the future to have Dubai property and flip Dubai property, sure. But in the early days, I'll definitely like build out in the UK, which is exactly what I did. And as I continue today, I still invest 90%, 95% in UK and only 5% in the UAE for the reasons that I've aforementioned within this video today. The last thing I want to talk about, actually there's two things I want to talk about, is the pace of the market. So one of the biggest lessons that I've learned in Dubai is that money loves speed. Again, like if you've watched my previous video, you'll know I'm a big fan of making quick decisions. In order to become the person that you want to become, in order to get to the position that I've been in today, I've had to learn to make quick decisions. Now I know notoriously in the UK, people make decisions a lot slower. People that are less wealthy tend to make slower decisions because they're generally less confident, they're less certain about what they're doing. They see it as a bigger risk, but it's only a perceived risk in their mind from a lack of knowledge. That's fundamentally what I believe to be true, and education has taught me that. And when you come to a place like Dubai, you're surrounded by a different mentality of business owners, higher level thinkers, maybe top 1% of the world of wealth is in Dubai. From my observations, from my experience, people make quick decisions. So when I bought the property in Emaar Beachfront for just under £1 million of cash, that was an investment decision that was made in 10 minutes. I was in Emar's sales office in downtown Dubai, and in 10 minutes the purchase agreement had been signed, deposit paid, contract signed, and £1 million, just under £1 million property purchased. Done. You just have a sales purchase agreement. There are no searches, there are no legals, there are no conveyancing. It's just done. It's a very quick market. That's great about Dubai. I love that because money loves speed. So Dubai is great for that. And when you sell the property and the transaction is done the same day, you go to the DLD, the land registry office, you transfer the titles, and you get a check and they bank it immediately in the same transaction. Like it all happens at once, basically. So things happen fast in Dubai. You complete on property within hours, if not a day. Whereas in the UK, like even if you're going to buy a property for cash, in my experience, in this current climate that we're in, November 24, it's slow. It's a slower market. Even if you're buying for cash, you're going to be waiting at least 12 to 16 weeks from the day the offer was accepted to buy that property. And the things that slow it down, obviously you've got two sets of conveyances involved. You've got the buyer's legal team, and then you've got the seller's legal team. They're both going to be going backwards and forwards, to and fro in. Things can break in the chain. I think it's three out of four deals fall through in the UK. It's slow, it's arduous. If you're buying in the traditional way and not at auction, obviously. You have to have your searches done. You have to have land registry titles updated. Some of my clients, and including myself, we've been waiting 6 months, even when we've purchased the property, for the land registry title to be changed before we can refinance the property. So these things make the UK a more slow market, which is a disadvantage versus Dubai, which is a much more fast moving market. It's more innovative, it's more disruptive, and I truly believe that's why Dubai, where it is, and it's becoming one of the leading hubs of the world and one of the fastest growing markets, is because of the speed of the transactions, whereas the UK tends to be a lot slower. Last point, if you're somebody watching this video and you found this valuable and you're looking to get started in property, I would suggest that you don't start in property until you've got at least £50,000 of cash savings to start, or equity to use, usable equity. The main reason I say that is you need money to get into property. I know a lot of people talk about like no money down strategies and all these sorts of things, but to keep things really real and really authentic, you typically need money to get started in property. There are more advanced creative strategies, creative financing strategies, but I'm very much of the opinion of working with professional individuals that need capital to start. That's how I started. That's how I built my portfolio. So if you're somebody who's got £50,000 in cash, what would be the first property that you buy and how would you go about it? In my opinion, typically the best way to do this is to buy an off-market deal. So you're looking for a motivated seller, a motivated vendor, where you're going to buy on 20% below the market value. So you're going to look for an asset, you're going to look to buy it for about 100, 120K. You're going to buy below the market value, look to get a 20% discount from a motivated seller. You make money on the day that you buy, not when you sell. You're then going to add value to that property. So you're going to do some form of refurbishment, some form of renovation that's going to enhance the value. And then you're going to look to refinance that property as soon as the refurbishment is finished. We don't have to wait 6 months anymore. We can get in and out quicker now in the current market. So we can buy, add value, command a higher value, refinance, and then take most, if not all, of our money back out of the deal to use the same pot of cash to buy property 2, 3, so on and so forth. Now, if you really want to get super strategic about this, the way that I would do this is maybe my first deal. I spend 50K. I buy it for say 100K, for example, or I look for the purchase price at 100K, I get 20% discount, so I end up buying it for 80K. I take out a 75% loan to value mortgage, I put down the deposit, I use the rest of the 50K to do the renovation, the refurb, the purchase cost. I then refinance it. And let's say I ended up leaving 10K in the deal and taking 40K back out with the deal. Just for argument's sake, to keep things high level for this video, I'd encourage that you need to be looking for returns of about 20, 25, 30%, maybe even higher if you want to scale faster. The next property that I would then buy is I would probably buy a property that I could add value to and flip. So if I put like 20K deposit down, I want to make 20K profit from that flip. So I'm kind of looking to double the money that I put into an investment for a development strategy. And I'd run the two parallel. So it might be like a 3-to-1 ratio. For every 3 properties that I buy, which I buy, refurbish, refinance, whatever the cumulative sum I've left in those deals. So let's say it's 15 in deal 1, 15 in deal 2, 15 in deal 3. That's the 45K used up. The fourth property I might buy would be, I would need to do a deal that would profit me 45K of cash, so that I've now recycled all of the money that I started with across those 3 deals. I'm left with the 50K after 4 deals, 3 properties that are bringing me cash flow, maybe £500 to £1,000 a month, let's say, depending on the strategy that you utilize. Let's call it £1,500 to £3,000 a month of cash flow. And then the fourth property I'm going to flip and recycle the 50K that I put into these 3 deals that got tied up. The fourth property I flip for profit. Now this fourth property that we flip for profit, you might be thinking, well, if I've tied up the 45K over here, how do I do this flip? With a flip, the great thing about flipping is you can use private equity. You can use 100% of other people's money on a flip to buy that property for cash and then sell it for profit, giving them a first legal charge. It's very safe for them. You can offer them a 10, 12% return on their money. They're almost like the bank. They get a first legal charge. You've bought the asset under market value, so it's very secure for the investors. They like it. And at the same time, you go and do the work, renovate the property, put it back on the open market, sell it, split the profits, and then you move on to the next, so on and so forth. That would be kind of like a high level roadmap of how I would start if I was to do this all over again, starting with 50K. I hope you found this video valuable. My company is called propertyconsulting.io. We work with everyday people to help them build their property portfolios. We typically work with people that start with 0 properties in our front end product called Property Investors Accelerator. They may have 0 up to typically 0 properties, but maybe have 50K in cash to get started, and they're looking to get out of their corporate job. If that's you, click the link below or somewhere around this video and you can speak to ourselves, book in a consultation, see if our services are fit for you, and we can help build your portfolio so you can get out your job. In another term, quit the rat race, so to speak, and become financially independent. Now, we also work with people who are more financially literate, higher net worth individuals that may have a property in their privately owned name. Our largest clients have 144 properties. We're used to working at that level as well, and we help them to restructure the whole taxes to their property portfolio. Maybe they've got an inheritance tax problem, a capital gains tax problem, a Section 24 income tax problem. We help them to restructure the estate, restructure the properties, give them all the options appraisal, and then help them take their portfolio to that next level as well. So if you're somebody else who's another individual that maybe has anywhere between 2-3 properties all the way through to 200 properties in your personal name, or combination of personal company without a family investment company or a smart company attached to it, and you want to learn more about how to scale your property portfolio using financial perspicacity, and you want to grow that portfolio, feel free to click the link somewhere around this video, book in a consultation with my team, and we'll see if there's alignment.